Good day, everyone. Welcome to our webinar for the 6th of November 2019. I'd like to start, as I usually do, in America, where the S&P 500 over the last 2 trading days has broken cleanly up out of the pattern that it was in and has made 2 straight days of record highs, closing on Friday at 3078. Which is a new all-time record high. When you're considering this, it's important to consider the context within which this upward breakout has occurred. And to do that, just to simplify it, I've put some charts into Word. I hope you don't mind that. They are share-friend charts, and I'd like to start with this chart here, which you see on your screen now. This shows the bull trend over the last 10 years in share-friend, okay? So going back to March 2009 and right up to the current day. You can see the bull trend began in March 2009 at an S&P index level of 666. Here you can see the long-term channel lines within which it's been operating. And during that time, there have been 4 major corrections. This one here, the second one there, the third one here, and then, of course, this 4th one, which is Donald Trump's correction caused by the trade war that he initiated with China and other countries. Throughout this long bull trend, we have been consistently bullish. Even during the corrections, we have characterized the corrections as buying opportunities rather than as the start of a new bear trend, and we've been consistently correct in that position. And that same idea applies to this correction of Donald Trump's. We always said this is a buying opportunity and that the market will break to a new record high in fairly rapid order. Other experts seem to be confused by this apparently endless bull trend in the S&P 500. They're saying that because it's gone on for 10 years, it should definitely correct. I mean, that is the longest bull trend that there has been since the S&P 500 was started, which occurred in the 1950s. But we believe that this bull trend is different from other bull trends because it is based on quantitative easing, and I'll get back to that in a moment. Our bullishness, of course, is underpinned by the fundamentals. The American economy is going like a train. The Fed has just cut interest rates for the 3rd time this year by another 0.25%. And the U.S. economy is generating 161,000 jobs a month, new jobs every month, on average so far this year. And that, of course, compares with last year when it was creating 223,000 new jobs a month. Which is obviously considerably more, but you cannot expect that economy to continue producing jobs at that rate as it approaches full employment. It's now sitting with an unemployment level of around about 3.5%. And any economists will tell you that is, for a big economy like America, that is approaching full employment, which means that everybody who wants to work is working. And the result of that is that now wages are starting to go up. In this last period, wages went up 3%. Employers are having to pay more for scarce labor at this stage. And of course, we can see the S&P 500 breaking to new highs, and that reflects the improved profitability of the 500 companies that make it up. The bull market is continuing. The upside break shows that quite clearly. And the further this market goes up, the less bears we're going to have. There are still bears out there, people who say that the market is at the top or close to the top and it's about to crash and you should sell everything. We always consistently have taken the opposite point of view. But those bears, every time we have a new record high like that, the bears lose credibility and they are sidelined. And of course, the closer you get to the top, the less bears there will be until eventually nobody will dare to call the top of the market. And when you see that there are no bears left and nobody is willing to call the top of the market, that, of course, is a good time for you to sell out and put your money in cash and wait for developments. All right, so moving on from the S&P 500 now, looking at the South African political situation. So I'm going back to the S&P chart here. Here you can see the breakout, the upside breakout, the last 2 days, Friday and Monday. And we believe that the bull trend will now continue. I'd now like to turn attention to South Africa and to what's happening here. And I'd like to begin with the political situation, or developments within the political situation. The ANC's plan on structural reform, which came out a few weeks ago, was a complete waste of time. They just trotted out the same ideas that they'd been putting out in the 2011 National Development Plan, which, as we all know, really didn't get implemented. And it's impossible, really, politically, for them to produce a cogent plan, because within the NEC, the ANC's NEC, National Executive Council, there's a great fear of the unions. They're worried about the unions. And any kind of cogent reform process within the South African economy is inevitably going to bring the government into conflict with the unions. We say that that conflict is inevitable. The government is talking about strategic equity partners, which is just a euphemism for privatization. They can't use the word privatization. It's a real no-no word in South Africa now. It's politically incorrect. So they use this phrase, strategic equity partners. But it is the same thing. They're planning to bring in private capital to take over certain state functions. Of course, privatization will greatly improve efficiency, and it will also raise capital for the government to enable it to pay back some of its debt. I think it's important to understand that state capture is not a unique idea in South Africa. In fact, it's commonplace in Africa generally. The best example being Zimbabwe, where the country's economy was completely destroyed eventually. We've had 9 years of state capture. The cost is estimated at roughly 1.5 trillion rand, and it's going to take us some years to recover, even with the best management. And if we look at the economy, of course, it's been a news-heavy month with the mini-budget coming out at the end of October, and then Moody's taking us down to a negative outlook. The budget, of course, didn't contain much that we didn't already know. We knew that there was a huge amount of debt, and most of the things that came out in the budget had already been discounted into the markets. But the bald facts disturbed the market. The bald facts stated like that disturbed the market, and the rand went briefly over 15 rand, and the R186, the yield on that long bond, weakened by 0.5%, but both are recovering rapidly. The budget showed that the deficit would be 2% higher than was estimated in February this year. That's a big jump. The main reasons, of course, we know them all: Eskom and the other SOEs that need constant bailouts, the under-collection of tax, which is estimated at 53 billion in this period, and, of course, government overspending. The government wage bill is out of control and needs to be brought down substantially. Tito Mboweni has produced a requirement for government departments saying they must cut expenses by 5% next year, 6% the year after, and 7% the year after that. Moody's has given him 3 months to show savings of 150 billion rand. This will certainly again lead to a conflict with unions. So that is what we anticipate now. We anticipate some sort of conflict with the unions, between government and the unions. In other economics news, which is important from this month, Enoch Gondwana, who is the head of the ANC's economics division, says the government will not implement prescribed assets. Obviously, this is a great relief for the financial community in South Africa. Prescribed assets really don't help anyone, and they will probably cause a flight of capital from South Africa. Then we had the third quarter figures coming out, with consumer spending up just 1.1% against expectations of 1.7%, which shows that the South African consumer is still taking enormous strain. The CPI, the level of inflation, consumer price index, was just 4.1% year on year in the year that ended on the 30th of September. This is well below the midpoint of the target range, and of course opens the way for the Monetary Policy Committee to cut interest rates by another 25 basis points, 0.25%, when the MPC meets in November. Then we had unemployment figures which came out at the end of the third quarter. South Africa has a workforce of 38.6 million people. 38.6 million people. And that includes people in the age group from 15 years old to 64. And that workforce increased by 149,000 over the previous quarter. Of those people, 38.5% are unemployed. So we are actually going backwards. The economy is not creating enough jobs to absorb new people entering the job market. And that is obviously a main concern. While we're talking about the economy, we need to talk about Eskom, because Eskom is a major component now. The fact that we slipped back into load shedding in October after 200 days of continuous power was a bad sign. It shows that all at Eskom is far from well. They have an insufficient safety margin, so when one or two of their power stations go out or something happens, they cannot keep the lights on without load shedding. Stage 2 load shedding, which we had then, cost the economy roughly 2 billion rand per day. That's an estimate. Pravin Gordhan has come to the party and said that he is going to set up a separate distribution company with its own board and its own CEO, and that company will simply buy power from anyone who's got it. So independent power producers, Eskom power stations, and so forth. It will buy power from them and then supply that power to the consumers and businesses. Obviously, this will be done on a completely equal footing, so there will be an element of competition here, which should bring prices down. But that will also mean job losses. The government appears determined to implement this, and so again, this leads directly to some sort of conflict with the unions sooner or later. The distribution company must deal with electrical theft. There's a huge theft problem with electricity in this country. An audit needs to be done to connect the power which is being delivered with the money which is being received. It's really a very simple concept. And then, of course, they brought out the integrated resource plan for power, and that said that we would have unreliable supply for the next 4 years, which is quite frankly unacceptable. The solution to this is to allow what is called distributed generation, which means that they must allow companies particularly to set up their own power arrangements so that they supply their own power. And everyone in South Africa is trying to get off the grid. Companies, private individuals, everybody. What is interesting is that the renewable energy situation is becoming inevitable. The price of renewable energy, particularly wind and solar, is becoming so cheap that it is going to take over sooner or later, one way or another. So the integrated resource plan is already becoming irrelevant. Costs are coming down very rapidly. It's really only a question of how exactly South Africa will make the transition to renewable energy. The 13 coal-fired power stations which we have in South Africa are dinosaurs, and they will all shut down sooner or later. The unions, of course, will object, but they cannot oppose the raw economics of renewable energy. In the end, unlimited cheap energy will be very beneficial for the South African economy. All right, let's talk about commodities. Our friend Gwede Mantashe, who's the Minister of Mineral and Energy, is very intransigent over the third charter. As you may recall, the third charter incorporated this principle of once empowered, always empowered. And that was done at a 30% BEE stake, or previously disadvantaged person's stake in the company. Now Mantashe says that only applies until the company or the mining license is sold. When it is sold, then the new owners must re-establish the BEE at 30%. So this obviously is departing from the once empowered, always empowered principle, and it makes it far less attractive for overseas investors. So that is a big negative that came out during the month that we're talking about. Negotiations between AMCU and the platinum producers is in progress. Joseph Matunjwa is putting on a very brave face, but he's just had the hell beaten out of him by Sibanye and Neil Froneman. And he says that, the platinum workers are ready to go on an extended strike, lengthy strike, if necessary. But Sibanye and other platinum producers are in a good position. Platinum prices have been going up. The PGM group of metals has been going up. And I'll talk a little bit more about that in a moment. So they've got plenty of cash. And a lot of that cash is not being generated in South Africa. It's being generated overseas, such as Sibanye's Stillwater mine, which is a palladium producer and is doing extremely well. So I don't think that Matunjwa will invoke a long strike, because I don't think his workers, his members, can stomach a long period of time without getting any pay. Mr. Kudifani, who is the CEO of Anglo American, says that the mining sector can create a lot of jobs. It can actually rebuild the economy. But for that, overseas investors need absolute certainty about the legislation. If they have that absolute certainty and the legislation is not too adverse, then it will open the door for a flood of cash, and that will create plenty of jobs in the mining industry in this country. Of course, precious metals are in the middle of a bull run, mainly palladium and rhodium. The demand for auto catalysts plus concern over Russian stockpiles has pushed prices up, and that has pulled other platinum group metals up with them, including platinum itself. South Africa has 4 main producers of platinum: Impala, Anglo Plats, RB Plats, and Northam. And then, of course, there is Sibanye, which produces both platinum and gold. The index for precious metals is up 40% this year so far. But the future does depend on continuing growth in the world economy, which we believe is inevitable. During 2019 so far, there have been 20 organized attacks on mine refineries. So these are organized attacks by gangs of up to 20 heavily armed individuals, and what they're doing is looking to steal the gold concentrate produced by these refineries. DRD Gold is the latest example, where 16 men attacked the complex and they escaped with 17 kilograms of gold concentrate worth about 12 million rand. In the process, a security guard was shot dead. After some time, the police managed to recover about half of that gold. But of course, these kind of things are not good for South Africa's image overseas. They do not help us to attract international investors into our mining sector. On the good news side, Master Drilling is testing its tunnel boring machine at Northam's Eland mine, and it's going very well apparently. This tunnel boring machine drills horizontal tunnels with an incline of either plus or minus 12 degrees, and it does about 1 meter per hour. This compares to the conventional method of digging these tunnels, where progress is achieved at about 2 to 3 meters per day. So this is vastly better. It's a vast improvement, technical improvement. It also requires far less staff to run this machine. Master Drilling is busy perfecting a similar technique to dig vertical shafts going straight downwards. This could revolutionize mining in South Africa and indeed worldwide, and it is something to watch closely. All right, let's talk about the companies, certain companies. I'd just like to mention just a couple of new listings which may take place quite soon. One is that Engen may be listed next year. They want to raise funds for a refinery. Engen, of course, is owned 74% by Petronas, the big international oil company, and 26% by Phuthuma Nhleku's Pembani BEE company. and they are a fuel retailer, as you know. It has petrol stations all over the place. That should come to the market next year, and we think it will be a good investment. The second company that may be listing is Respublica. This is a property company which basically focuses on student accommodation. Apparently, there's a national shortage of about 250,000 beds for students. Respublica currently has 9,300 beds and plans to get that up to about 12,000 by the end of next year. It is 51% owned by Redefine, which is obviously one of the biggest property groups in South Africa. It has suffered a little bit with the fees must fall attack, and that delayed the listing. But it is still planning to list on the JSE if the economy improves, which it could well do next year. I'd just like to talk a little bit about retail because things are happening overseas which we should pay attention to. Online shopping is gaining momentum in America particularly. In 2018, 5,590 stores were closed in America because they basically were unprofitable, and that was due entirely to online shopping. This year, the number is around 8,000 and is expected to rise to 12,000 stores closed. And in another development, Forever 21, which is a very big clothing company, has filed for bankruptcy, again because of online shopping. This pattern will be followed in South Africa. There's no doubt about it. We maybe lag a little bit behind the rest of the world, but we will sooner or later move to online shopping. And that means that retail outlets are endangered, and particularly properties which accommodate retailers. So I'm thinking of things like the Africa Mall and the newly completed Fourways Mall, which are based on retail. So you just need to consider that. But in general, I believe that the place to be investing right now is in the property sector. If we just have a look here at the SAPY index, which is the property index for South Africa, you can see here that after it was in a very strong upward trend, and then after a long sideways pattern, it collapsed. And we're now down at these low levels. And this to us represents a buying opportunity that you should probably be taking advantage of. In 2018, that's this year here, the property index fell by 25%. That's substantial. And we think that there's quite a good probability of some sort of recovery occurring over here now. One of these companies is the Resilient Group, which I'll just put on the screen for you. And this group of companies, Resilient is just the main company. I'm just going to put 5 years data on the screen. And you can see how their share collapsed. Obviously, there was a report that came out by 360 Asset Management. And that claimed that there had been insider trading and share price manipulation and so on. So far, the investigations have turned up absolutely nothing. But the share price of Resilient, which at its peak over here was trading at 150 Rand, collapsed to a price between 50 and 70 Rand. There seems to be resistance here at 66, so some kind of an island was forming here, and we now seem to be having what looks like an upside breakout here. Resilient is a very good company. It owns 38 properties here in South Africa and 4 in Nigeria. So it's recently bought back 52 million of its own shares at these lower levels, and it has a loan to value of 26.8%, which is extremely good. So we see this as a potential buying opportunity. Another property company that is worth looking at is Equites. Equites is the only real estate investment trust in South Africa which specializes in logistics and distribution properties. So they're buying warehouses and distribution properties which can be used for online shopping. They recently bought a 100,000 square meter logistics property in Germiston, which is occupied by Simba, a very good tenant. The CEO of Equites is a lady called Andrea Taverna-Tieresen, and she said, a wall of cash is leaving retail and going into logistics. And that should be something you need to pay attention to. So it's moving out of retail and going into logistics. The return on this company since listing has been 25% per annum since it listed in June 2014. So it's certainly worth looking at. All right, I'd like to talk now about Spear. This is another small property company, but one which we really think is worth taking a look at. It's a company run by two guys, a guy called Mike Flax and another guy called Quinton Rossi. Both of them are experts in the property situation in Cape Town. And indeed, Spear focuses just on the Cape Town area. And they have a share price which is around 900 cents at the moment. Yes, 905 cents. And they have a net asset value of 1,167. So they're trading well below their net asset value. As you can see, they fell with all the other shares. And now we think that they are very cheap at this level. Obviously, property in Cape Town is far better than in the rest of South Africa. The average vacancy rate in Cape Town is 7.7%, which compares with Johannesburg at 12.2% and Durban at 13.6%. So property in Cape Town is definitely more in demand. We believe that this share is one that you should definitely look at. And then we wrote an article about this company, Baldwin, and we suggest that you go and reread this article. I'm just going to put 5 years on the screen there. You can see that this company also suffered from a significant downward trend, but has since then formed an island. That island has lasted most of this year, and now what we're getting is a clear upside breakout over here. Baldwin is as close to a sure thing as you will find on the JSE, mainly because it's trading now for around 350 cents, around about that level. There you can see it now, 350. But it has a net asset value of 593 cents. So it's trading at a significant discount, above 40% discount to its net asset value. We think it's a takeover target, and we think that there's a good potential. It ticks all the boxes that private investors want. It has sufficient volume traded to make it practical to buy and sell. It is trading well below its net asset value. Its net asset value is based on properties, so it's a very strong net asset value. It has excellent management. It is developing an annuity income through doing rentals as well as sales. And it has minimal working capital, and it is not overgeared. So this is the kind of share that as a private investor you really need to be thinking about. Ladies and gentlemen, thank you very much for listening to me. And I will talk to you again on the first Wednesday of December. And thank you again for taking the time out to listen to our webinar.